the YouTube channels. So like I said today, welcome you all guys to our 7th session of our lockdown sessions. And I discussed with Bongeni earlier, we should continue doing these Zoom sessions, even in his absence. So yeah, like I said, his brother passed on, so he was not able to attend these sessions. So in his absence, we have to keep on doing business and continue to help others in ways that we think are necessary. So today we want to talk about market sentiment. It is something that a lot of people, they actually ignore, or rather a lot of people, they don't really understand much about market sentiment and its effect in making trading decisions. You notice that even when you are still a beginner, they talk about sentimental analysis, in whereby you should also be able to actually know the sentimental part of trading. But you know, a lot of people, they don't really have an understanding of what exactly is sentimental way of analyzing the market. What exactly we'll be talking about? I'm sure you notice that a lot of people, they actually overlook, or they have a tendency of ignoring that. But it is also a very important tool. So market sentiment, as you all know, it is a way of projecting a potential move that the market is likely to take based on how our traders positioned in the market. Based on how traders are positioned in the market. Traders' position is very, very important, because you know what is the possible move the market is likely to take. One thing you should appreciate is, we as retail traders, the market makers, they always want to trade against us because they want to make money from us. So they always make sure that they look into the way traders are positioned into the market, and then they make their decisions based on that. So with the way of analyzing the market, there is what we call a COT report, which we call a commitment of traders report, whereby you are able to know where the liquidity providers have injected much of their liquidity or their money to move their markets to. So at the end of the day, when you are trading the market maker cycle or the market maker system or part of BTML, we always say that you should trade in line with the market maker being the person who we have got a big influence in the market, we have got a big influence and a big equity base, and they've got a big influence in the political arena, being able to affect market movements. That is generally who a market maker is. And banks, they play as market makers in the market. Some hedge funds, they also play a big role as market makers in the market, and big financial institutions. All these are market makers. These are the people that provide the liquidity that move the market. But in so doing, they need to make money out of it. They need to make sure that they profit out of it. So it's very important that we discuss this. So let me take you to what we call a commitment of traders report, so that you're able to see what really happens in the market. Where are the liquidity providers injecting their money? Where do they put their money? So I want to take you back to some time last year. I want to use pound US dollar. Let me open my chart so that I can actually show it to you. I want to talk about GBP USD as an example. Let me push it back. Let me zoom it a little so that you are able to see the area that I'm actually trying to focus on. Right. Can you all see my screen? If so, please raise your hand so that I can actually notice that you are seeing my screen. Okay, fine. So if you can notice, the whole of last year, that is 2019, we had a good bearish cycle in the market, whereby the market actually followed a good market maker cycle, and we had the market dropping almost the whole of the year. The whole of last year, ever since sometime around February, we had the market coming down. As you can see, we had the market forming an M formation. This was the peak formation. They created an A1. They went down, they created an A2. I'm sure these are the things that we've been talking about ever since we started this, knowing the market maker cycle. Then they formed a W formation there. So this was a clear MAAW formation, in which we talked in the first session of the cycle. And you can actually see it on the daily time frame, which means it was easy for one who knows the market maker system to trade the whole of last year. We actually, I think I traded the last push, the second pullback all the way up until the peak formation low. I actually managed to catch that trade. I only managed to realize later that daily time frame had a good structure. Then, as you can see, based on the market structure or on the technical analysis, our cycle was already favoring that the market is going down. Then, looking at the commitment of traders report, let me take you back to what I call the commitment of traders report, which actually tells you where the market makers had injected their liquidity or their money. So this was last year. This was some last year around, let me check the dates there. It was somewhere around July. Like I told you, I had to trade the last push of the market, the last pullback, the last level of the daily time frame. It was somewhere around July. Then this was the commitment of traders report. I'm sure you can hear from the commitment of the traders report. We had the British pound as our asset that we were trading here. And on that, we had the dealer intermediary. So what we refer to as the dealer intermediary, we are referring to as the position of retail traders that are held by all the brokerage firms that participate in the market. So the dealer intermediary is the position of retail traders, all combined, that are in the market at a certain time. So all this data shows how the retail traders were positioned in the market. So we have got the long position, then we've got the short position. So as you can see, we had 129,059 long position holders, which means all the pairs that had GBP, XXX, it had a lot of retail traders that were actually buying it. and we had 4,185 traders that were short. So which means we had 129K against 4,000, which means there was no way that the market would be going long, because if the market is going long, it would pay a lot of retail traders, and the market always look to move the market in the cheapest possible way or in the cheapest possible means, which means the only probable movement they were likely to take was to keep on selling the pound, as there were a lot of retail traders that were trapped in a buy. So moving the market to the upside would actually make the market makers lose more money to the market. So that's why they had to choose the alternative, which was to go down. So already we had the market structure or the technical analysis based on the market maker cycle favoring a downtrend. And we had also this position of the traders in the market also favoring a downtrend. Then moving on, we now go on to the asset managers, which are the institutions. These are the market makers now. These are the big banks. These are the liquidity providers. These are the people that move the market. And as you can see, we had 52,000 against 118,000. And you know the market makers, they've got most of the liquidity. We are talking about hedge funds, we are talking about banks. So most of the banks and most of the hedge funds, most of them were in short position, which means their liquidity was injected to make sure that the pound goes down. That's why GBP XX pairs were going down and XXS GBP pairs were going up for almost half the year. These positions, they rarely change because banks and hedge funds, they don't do our kind of trading that we do, in which we enter a trade today, we exit tomorrow, or we enter a trade in the morning and we exit at the end of the day. When they hold positions for a long time. So when they inject liquidity, it means they're entering positions which are going to affect long-term positions or long-term trades. So you can actually know where the banks have injected in capital and where there are a lot of asset management firms and a lot of institutions injecting money in that direction. That is the direction the market usually takes, because they look to profit more out of this, and they always go in the direction that they have injected their liquidity. So it's also an addition that you need to move to trade in line with the dealer. So this can help you know the overall direction the market is likely to take over a long period of time. So already you've got the COT positions. You know how the banks have injected in liquidity. You know how the retail traders have injected in liquidity. And you know the market always look to move the market in the direction that favors them the most. So going back to the chart, we can actually see that for almost all the whole year, the market was going down, and it was following the market maker cycle, which means if you know the market maker cycle, you know that this was an extra confirmation to actually know that for real, the market is actually going down. And I think almost most of my students that I was teaching at the time, they actually benefited a lot from this trade, because we are analyzing these pairs together using all these COT reports. Then when the market reached its level 3, then they created a peak formation. They actually started to go up. And when they were going up, positions actually changed. You are now seeing a decrease in the injection of the liquidity providers, now favoring the buying of the pound. It's unfortunate that I forgot to draw to take the screenshot of that. And all short positions, they were now reducing, and the market makers are now injecting liquidity into the buy positions. And you can see sometime around August, the market started to go up again, and they went up the whole 3 levels again. They actually respected the market maker cycle. They created the peak, they created the V1, they created the V2. This is the area in which they spent almost two good months consolidating this area. I knew that they had to go for level 3 because we had 1, we had 2, we had to push to level 3. This is the time whereby there were elections in Britain, and they used the election to actually push to level 3. This was election news that was used to push, which means when you know the market maker cycle, the dealer always gives you a structure, and they always find an excuse to move the market. Everyone who trades the BTMM, they know that we don't pay attention to the news. We know news is used to accelerate levels, but as far as knowing the market direction and the market patterns, you would have already known the direction the market is supposed to take. So what they were doing here, a lot of retail traders, they were induced to sell. Why? Because there was a very strong resistance. That's why we say that trading only support and resistance is not enough. There was a very strong resistance on the daily time frame, and you can actually see rejections. Everyone who trades support and resistance will say we have got a very strong resistance right at the top there. And a lot of traders will be induced to actually sell, but that was actually a trap. I actually warned some of my students that there is no sell on GBP pairs. Just to wait for them to give you a good buy setup. They will actually go to level 3. But a lot of people, they actually lost this trade because there was some validation of a very strong resistance here. But in terms of level count, we knew that they have to complete this level. And this was a way of trapping. So the market, they make sentiment and go against it. So in this way, they were actually validating a very good resistance so that you can actually be induced to sell. So imagine how many retail traders were induced to sell. Everyone that trades support and resistance, validating a very strong resistance at the daily time frame. They actually had to wait for election time to push for level 3, and they pushed it to level 3 as an excuse. Boris won the election and pound pushed to level 3, and we knew that they were ready to reverse. And what did they do after? They actually created a very good peak formation again. After that, they had a very good peak formation, and then they started to go down. So it's also important to know the overall direction the market is likely to go based on the positions that the market makers have injected in their liquidity or their money. So looking at the current at the current statistics right now, you can see that the pound was falling almost since the beginning of the year, all the way and all the 3 months, 4 months up until now. If I'm to check the current COT report, let me check right now. Let me check in right now where we are at the moment. So all those that want to see where I find the COT report, you can find the CFTC, www.cftc.gov. It stands for Commodity and Futures Trading Commission. That's what it stands for. So if I look for pound, let me look for pound. I've got pound sterling here. And I have dealer intermediary positions here. I've got asset management positions here. As far as dealer intermediary positions, we have got 52,000 long position holders, and we've got 16,000 short position holders. Then on the asset managers, we have got 40,000 against 65,000 in the short position. So these positions, they're actually changing. You can see that it's now almost equal. We've got 40K against 65 positions as far as asset managers or banks are concerned, as far as capital injection into the market is concerned. The reason why is a lot of hedge funds, they are not actually trading at this moment because of uncertainties of global economy. That's why you can actually see from the previous post that I showed you, you actually saw that there were around 118,000 institutions that were short of pound, which means that a lot of institutions that had injected their liquidity in the short positions. But with these positions that are here right now, you can actually tell that there's a lot of uncertainty in the global economy, and there is less participation of these liquidity providers because they also participate in the market to make money. So they are afraid of also losing from the market, which doesn't have a certainty of how the global economy is actually going to perform. With this whole coronavirus thing, there are a lot of businesses that are closed down. So this can tell us about the current situation that is actually happening right now. But knowing this is important because we are not going to stay in this position for a long time. This is one crisis that is going to go, and you're going to use this as long as you're still trading. This will be a good tool for you to use. So even looking at the current stats, we still have a lot of asset managers that are in short of the pound, although they are a few as compared to how they were positioned sometime last year or the beginning of the year. And you can actually see from the market positions right now, we can actually see that overall, since the beginning of the year, the market was actually going down. And the market started to gain, started to go up, which gives us here whereby you can see that we have got positions of those that are long on the pound almost equal to those that are short, whereby you can have a probability of the market playing 50-50 in terms of market positions. So this is for long-term trading, whereby you look to hold a position for quite a long time, knowing where the banks have injected in their liquidity and know where the market is likely to go in a long period of time. When you know this, you can then use your technicals to actually to look for structures that actually favor the direction where the liquidity providers have injected in their liquidity or their capital. Okay, with that being said and done, I now want to go into talking about commitment of traders' positions as far as trading in an intra-week or intraday trading is concerned. We know that a lot of traders, they are either intraday traders, some they are swing traders, but there are a few swing traders. Most of us, we do intraday trading or scalp trading. So it's also important to know how traders are positioned in the market to actually tell you the likely possible direction the market is likely to make in a day or that day, or if the market is likely going to make a move or not. So if you go to, let me share where I usually get this information. if you go to XM dashboard, you're able to see the XM trader dashboard, which tells you how traders are positioned in the market, where there is a XM trader dashboard, the positions of the traders. So usually this is the sentiments that changes every day, usually, or every 2 to 3 days, which affects the actual positions retails are making into the market. So as you can see here, I've got Euro USD, I've got USD JPY, I've got Euro JPY, I've got GJ, I've got Euro Pound. So usually pairs that move without a lot of manipulation are pairs which have got a 50-50 market position of retail traders. They've got 50% sellers and 50% that are buying. Usually a probability which is between 60-40 and 50-50 is actually the pair that usually faces less manipulation as far as intraday trading is concerned. Because the dealer or all the brokers, they are connected to the liquidity providers that are the market makers, which means that's why the market makers are able to see each and every position every retail trader is taking. So they actually see which move benefits them the most, or which move give them the max losses. And the dealer always makes sure that they choose the direction that makes sure that they make less loss out of the movement. So if you try to look, there are certain times whereby the market doesn't move, whereby technically this pair is supposed to buy. And it can spend even 3 days to a week without even moving. Then you wonder, why is this pair not moving? If you then go and check on the trader position, you can actually get an insight, said, all right, so this pair is not moving because it's supposed to buy, but there are a lot of buy positions here. So the market will never go there because it will pay a lot of traders if they go in that position. So let me look, for example, like Euro JPY. Euro JPY have got 74.8% that are buying against 25% that are actually selling. Looking at Euro JPY on the charts, it is supposed to go up. Let me look for EJ. Looking at EJ right now, I've been stalking this pair for almost since Friday because they created a very good peak. They are now in level 3. We are actually expecting a reversal. We had a good peak forming there. Then they formed another peak here. They created a good peak last week. Then they went up. Then they went down again. The dealer finds it cheaper to retest a previous tested price instead of going into a new price area. So in this way, they are still working on the peak formation on the 1 hour time frame. So in a way, they're actually consolidating in this area. They're still holding this peak formation. Why? Because they are supposed to go up, but just because of the position of the traders that are in the market, if they go up, it means they are going to pay 74% of the traders because technically the market is supposed to go up. So there is a time in which BTMM traders, they actually see level 3 and they see a buy. And retail price action traders, they actually see either a very strong support and they're actually anticipating a buy. So we are a lot of traders that will be taking that buy position. And for the market to actually move, it will be difficult because we've got a lot of traders that are in that buy position. And for the market to move to favor that direction, it won't, because it becomes expensive for them to pay all those traders in one go. So they actually continue to chop around like this or change your market sentiment. And when the market sentiment changes, they will then go in that direction. Because they know that a lot of traders, you're not patient. You get tired and saying, this pair doesn't want to move. You either exit. And each time you exit a trade, just know that you're not the only one who's exiting. there are over 100,000 of you that are also exiting. So the dealer knows this. So they start to mess up around with the emotions, not moving this pair, only because the market sentiment is not allowing them to move that pair. And you can even check, this was XM, you can even check even most, it rarely changes. The values are almost close to each other. This is XM, and even if I go to, this is FX Pro, FX Pro Trader Dashboard, you can also see we have got a similar value in terms of market sentiment, in terms of how retail traders are positioned in the market, which means retail trader positions, just by looking at one trader position from any broker, you are able to tell the overall position of the retail traders. Because these values, they are almost similar across all brokers. So at the end of the day, that's why you see that only 10% or even less of traders are actually profitable. 90% of traders are actually losing to the market according to the statistics, because traders are conditioned to think the same way. That's why I always say that there is nothing wrong in knowing all the strategies, because they put you at a better advantage. A person who trades only support and resistance is very prone to lose much into this market, because the dealer needs to validate support and resistance. Because with support and resistance, if you check every YouTube channel, if you check any broker website which offers trader education, every trading book, all they talk about is support and resistance and drawing trend lines. In a way, a lot of traders are conditioned to think and behave the same way, so that when they start validating a resistance, they actually validate a resistance. And a lot of traders, just because of being exposed to the same content and the same material, we are all induced to take a buy when there's a resistance, when there's a support, and take a sell when there's a resistance. And then they validate this. Once a lot of traders have injected their capital, their liquidity in that, they then go in the intended direction. I can show you an example of Euro US dollar, what it was doing at the whole of last week. Euro US dollar, the whole of last week, it was holding this level. It was holding this level. And as you can see, it was actually validating a support around this area. It was actually validating a support whereby as a price action person, you say that this is a double bottom. Yes, it's a double bottom in this case. You can actually see them coming almost 3 times. So it's like a triple bottom, whereby they came all the time to test this low. That was the low of last week. And they kept on rejecting, which means a lot of retail traders were induced to buy in this case, because of only knowing about support or knowing about resistance. So some support is not real support, or some resistance is not real resistance. It's actually a dealer's way to trap and to take away your money. But a person who trades the market maker system, we actually knew that this was in level 2, and we knew that they had to keep on pushing for level 3. So we knew the dealer was actually trapping around this area, and we actually knew that they were actually going to level 3. So knowing your level count is also important. You can use any strategy, but knowing level count will take you to a better advantage in knowing where the market is likely to go. Because the dealer, 90% or even 95% of the time, they actually respect the market maker cycle. So knowing the cycle will put you at an advantage to actually know where the market makers are actually trapping traders here. I don't know if anyone have got a question. How do we access the COT report? So if you want to access the COT report, there are two websites that you can use. You can go, let me show you. We still have 15 minutes that we can use to, if you want to access the COT report, you can go to cftc.gov. That's where you can see the COT report is the Commodity Futures Trading Commission. You are able to see, you just click there, you look for Commitment of Traders report. Then after going to Commitment of Traders report, you can then go to, you scroll down to where it says financials. Then you click on long format, you are able to see that data. You can also go to, you can also use tradingstar.com. There's a website which we call tradingstar.com, which I normally use because it have got a better presentation of the COT report. So it's the same data, but this one is much more presentable. Tradingstar.com. It's called tradingstar.com. It have got all the COT reports. So you can find all the COT reports for anything, currencies, grains, livestock, stocks, indexes, treasuries and rates, energies, and quite a number of things. So you just go and click on COT. Then you are able to see all this information. It will be given on tradingstar.com. Let's see if anyone have got another question. Which current level is Euro USD now? In terms of which time frame? In terms of which time frame? Looking at Euro USD right now, Euro USD completed all three levels there. Now it's in level 1. Now it's in level 1 because the USD is in level 1 there. Because we've got peak formation, then we've got level 1 there. It's currently in level 1. They pushed an ADR, then they reversed it. So at the end of the day, we can count it as if they didn't move at all. But if they had moved and didn't reverse, would probably be in level 2, but they reversed this back into this. So we are still in level 1. Let me see if we have another question. What about GBP USD? Are there COT for indices like binary? At the moment, we don't. I don't know where we can access a COT for binary indices. I'm very sorry. Does COT work for major pairs only? COT doesn't work for major pairs only. It even works on cross pairs. So remember, COT, it gives information on let's say, for example, here, it's only showing COT for pounds, right? Which means it affects everything that starts with XXX, GBP. It also affects everything that starts with GBP, XXX. So which means if there are a lot of, there are a lot of long positions in pounds, it means that GBP XX pairs will be going up. If there are a lot of dealers or a lot of liquidity providers that are buying the pound, you find GBP XX pairs going up and XX GBP pairs will be going down. So Euro pound is a cross, and you can talk of GBP, JPY, you can talk of GBP CAT. So it affects all the pairs, not major pairs only. Let's see if I have another question. How do you count with swings or consolidation on the level count? Do you count with swings or consolidation on the level count? I've got a lot of ways of determining levels. Sometimes I use my EMAs as extra confirmations to mark my levels. I look for consolidations sometimes. I look for ADR. I use ADR to determine my levels. I even use drawing higher highs and higher lows to mark my levels. So it all depends with how the market presents, because the market presents itself differently each and every time. And sometimes if you want to use EMAs only, it might be difficult for you to actually know the levels, because they might not come at the appropriate time. EMAs are indicators, and we always say that indicators are extra confirmations if they appear at the right time. Then it all depends with how I can use, it all depends how the market presents itself to actually know which method I'm actually going to use. Can you present on use of ADR? Can you illustrate how to mark levels? Okay, how to use ADR. So with ADR, I'm sure you can see that on my chart, if you look on the top left corner, there is where it says 3 by ADR. And based on what we said the other time, we said that 3 by ADR is an approximate value, which tells us the number of pips the market is likely to make when it have completed the whole cycle. This is an averaged value. It's not like it's always accurate that if you measure 240 pips and actually show that if we have 240 pips, it actually means that we have completed the whole cycle, because ADR movements, they are averaged number of pips based on the movement that takes place over a certain period of time. So if you go to the Forex volatility calculator, it averages, let's say today if the market moves 100 pips, tomorrow it moves 100 pips, the other day it moves 100 pips, which means we have an average ADR of 100 pips, between 90 to 100 pips. It's an average which changes based on how the market is moving in a certain period of time. So we can have a fixed ADR for over 2 or so months. So determining ADR, like here is written 240, which means this is the value for 3 by ADR, which means on all the 3 levels that I have, I should expect to have a value which is close to 240. It can exceed, it can be less. It can exceed, it can be less, which means each level should at least be 1 by ADR, 1 by ADR, 1 by ADR. Which means if I measure from peak to peak, if I measure pips from this peak up to that peak, you can see here I have got 250 pips. I have 250 pips from there to there, which was almost the whole completion of the whole cycle. The normal ADR we had on our value was 240, and they did almost equal to 240, which actually entails that we are in level 3, and they did 250 up to there, then they reversed. I hope I've answered that one. I've already tried to use, but sometime engage in deeper loss. Just show us what exactly the way you use it. Which one are you talking about? Can you illustrate how you make levels? Okay, how I make levels, like I said, there are different ways in which I mark levels. So for now, I can just illustrate a few. So I mark my peak formation first. And once I have my 1350 cross, I know I have a peak lock there. Then after my 1350 cross, I know that's where my level 1 begins. Then I have my drop. Then I've got my consolidation there. I've got my drop. I've got my consolidation. And here they break the low that they set in level 1. Then I knew I was now in another level. Then they kept on testing the same high and the same low. If the dealer keeps on testing the same high and the same low, they'll be still in the same level. And also this, I had extra confirmations with my EMAs because I see a 50-200 cross, which actually tells me that level 2 is approaching. So a 50-200 cross can mean a lot of things. It can appear in level 2, or it can show you that a new level is approaching. Then the market kept on testing the same high and the same low, which means it was still in the same level. Then we went down all the way into level 3, which we found our reversal, our W formation. Then now we are in level 1. So we have got an ugly M there. We've got our A1 there. We've got our A2. We've got our W formation right there. I hope I have answered. And also another indication that we are in level 3, you can see EMA is fanned out. If you see EMA is fanned out, it's an indication of level 3 behavior. If you see EMA is fanned out, it's an indication of level 3 behavior, and we're actually anticipating a reversal. Let me see if I have another question. Can you help us on sniper entries? Today's session is not on entries. So with the time that I have right now, I'm not able to address entries because I will need the whole session to talk about that. How do I use the ADR high and the ADR low indicator? So on the ADR high, on the ADR low indicator, like here, when the market opens, let me delete this one. It gives you an ADR high and an ADR low indicator, which shows you that for any particular day, the market should move within this range, either moving up or moving down, depending on the overall direction of the market. So the ADR high and the ADR low, they automatically set at the beginning of each and every day. So that you know if the market is going to go up, this is the highest point it should move to. This is the lowest point it should move to. So when you see an ADR high, usually if it is closer, stop hands, they are usually formed on the ADR high. Then you can expect the movement of the market to come down. Like here, you can see we had a good Asian range of 19.3 pips. We had our three swipes to the high as a stop hand. Then we created an HOD almost close to the ADR high. Then the market reversed. This was actually a midweek reversal. Because we had a 3-day cycle. We had a 3-day cycle on Euro USD. You can see we had the first day of rise, we had the second day of rise, then we had the third day of rise. Then this was the midweek reversal. So we are actually expecting a reversal today. I think I talked with some of my students that today we are anticipating a midweek reversal. After an aggressive push to the upside this morning, then I said that they just wanted to finish M15 level so that they can do a midweek reversal. And they actually reversed back. So which means they reversed an ADR high, which is good as if they didn't move. They just got back where they were at the beginning of the day. Let's see if there's anyone with a question. I'm only left with 1 minute. These days, there are many trades in the Asian box. Why can't we trade in the Asian box? There is no one who says you can't trade in the Asian box. But what happens is Asian session is usually a consolidation, and that is what you can expect. But pairs that are paired with Japanese yen, with Australian dollar or New Zealand dollar, they actually move at night. But the setups for those pairs, they even come before we even go into the Asian session of the next day. If you want to see that Australian dollar, I've got a setup of buying, you actually see this, the setup towards the end of the day. They actually give you a buy setup, then they move in Asia. That's why we always say that sometimes you should avoid to trade in the Asian session. Though some setups, they appear in Asian session, but not most of them. But you can expect movement in pairs like paired with Australian dollar, New Zealand dollar, or a Japanese yen. But once a setup comes, even if it appears in the Asian session, if there's a good, clear structure information in the Asian market, you can still take it. You recommend to use of order blocks together with BTMM on M15 entries? Yes, you can use order blocks as part of your entries with BTMM. I myself, I also use order blocks in my entries combined with what I know of BTMM. So guys, thank you for joining us. Tomorrow we are likely to have another section. So I will advise if you're going on what we're going to discuss on, but it's going to be on the same time. That is 2200 hours. So those who didn't attend the session, you can find the session on Creative FX YouTube channel. You can also find it on the Forex Plugs YouTube channel. We're going to upload these sessions. So thank you for joining us. If you have got any further questions, maybe you can attend to my inbox. I'll be glad to assist you where I can. So enjoy the rest of your evening, guys. Thank you.